The Bogleheads, Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf. Picture this, becoming a millionaire on an ordinary salary. No lottery tickets, no mysterious inheritance, no lucky breaks on some hot tip your cousin's friend mentioned at a barbecue. Just something wonderfully simple, done consistently over time. Here's a story that might make your jaw drop. A few years ago, an investment company received a letter from a client who'd been with them since the mid-1970s. His portfolio? A cool $1.25 million. Now here's where it gets interesting. This guy never earned more than $25,000 a year. Ever. Wait, what? How does that even work? Was he some kind of stock market savant? Did he have a genius financial advisor on speed dial? Nope. He was just an ordinary person who stumbled onto an extraordinary idea that was almost ridiculously simple. He became what we now call a Boglehead. The book we're diving into today is basically the instruction manual for this philosophy. And get this, it wasn't written by slick Wall Street types in expensive suits. It was written by three retired everyday folks, Taylor Larimore, Mel Lindauer, and Michael LeBoeuf, who learned the hard way so you don't have to. They're part of this massive grassroots movement of millions of regular investors who follow the teachings of one of finance's quietest revolutionaries, John Bogle, the guy who founded the Vanguard Group. This isn't some get-rich-quick scheme. Actually, it's the complete opposite. Think of it as a get-rich-slow, get-rich-for-sure approach. By the end of today, you'll have a clear, simple blueprint for building your own financial freedom. You'll understand why most of what you see on TV and read online about investing is really designed to make other people rich, not you. And you'll discover the one secret that separates the financially free from everyone else, a secret so simple you might actually roll your eyes at first. But stick with me, because this is the exact key that unlocked that $1 million future for a guy making 25 grand a year. Let's start with something that might sting a little. Imagine 100 bright-eyed 25-year-olds starting their careers. Fast forward 40 years to retirement. What happens to them? The numbers are pretty consistent and, honestly, kind of shocking. 1 becomes genuinely rich. 4 achieve financial independence. They can live comfortably without working. But the other 95? They hit retirement age unable to maintain their lifestyle, relying on government programs just to scrape by. We're living in the wealthiest country in human history, yet only 5% of us achieve financial freedom. Why? The authors argue it's not about your paycheck size, it's about your financial lifestyle. They break it down into 3 categories, and I bet you'll recognize someone you know, maybe even yourself. First up, the borrowers. Their motto? Live for today, forget tomorrow. These folks build their entire life on a foundation of credit cards. Newest car? Check. Latest fashion? Got it. Biggest house on the block? You bet. All financed by mountains of debt. Credit cards feel like free money to them. Just pay that tiny minimum balance each month, and the party rolls on forever, right? When their home value ticks up, boom, they take out a home equity loan for that luxury cruise. Their financial future isn't just stalled. It's literally going backward, building what the authors call negative wealth. Their one job loss, one medical emergency, one unexpected disaster away from complete financial collapse. Next, we have the consumers. This is where most people hang out. They're not drowning in credit card debt, but they're living paycheck to paycheck. They look at their take-home pay, and their main mission is to spend all of it. When they want something big, a car, a new television, they ask one magic question: can we afford the monthly payments? They never calculate the actual interest or how long they'll be in debt. Their employer might offer a 401k with free matching money, literally free money, but they pass it up. They'd love to save, but there's always something they need right now. The authors nail it perfectly. The consumers think they own their lifestyle, but really, they're just renting it. Finally, there's a much smaller group, the keepers. These folks have a completely different mindset. While everyone else obsesses over their income, the keepers focus on their net worth. Their motto? It's not how much you make, it's how much you keep. They might not earn a penny more than the borrowers or consumers, but their financial future is infinitely brighter. What's their secret? One beautifully simple habit. The very first thing they do with every paycheck, before paying bills, before buying groceries, before anything, is make a payment to their future self. They save and invest at least 10% right off the top. They jump on any matching programs at work. They use credit cards for the convenience, but pay the full balance every single month. They don't live like hermits, either. They have nice things, take vacations, enjoy life, but only after they've paid their future selves first. They have a plan. This is the absolute foundation of the Boglehead philosophy. Before you even think about investing, you've got to choose to be a keeper. You need to shift from a paycheck mentality to a net worth mentality. The book gives us 3 concrete steps before buying our first stock or mutual fund. First, calculate your net worth. Think of it as your financial report card. Simple math. Add up everything you own. Cash, your car, investments. Then subtract everything you owe. Credit cards, loans, mortgages. That final number? That's your net worth, the true measure of your financial health. Make this an annual ritual. It's your starting point on the map to financial freedom. Second, demolish all your high-interest debt, especially credit cards. The authors are crystal clear here. Paying off a credit card with 18% interest is like earning a guaranteed, risk-free, tax-free 18% return on your money. You will literally never find a better, safer investment than that. Every dollar you carry in high-interest debt is making some bank rich instead of you. Time to get off that merry-go-round. Third, build an emergency fund. Life throws curveballs. Job losses, illnesses, disasters strike when you least expect them. You need a cash cushion, a separate, safe, easily accessible account with 3 to 6 months of living expenses. This isn't for investing, it's for sleeping well at night. It's the firewall protecting your long-term investments from life's short-term chaos. Once you've knocked out these 3 things, you've built your foundation. You're ready to become a real investor. And this is where things get magical. Ever heard of the Rule of 72? It's this simple mental trick that Einstein supposedly called the greatest mathematical discovery ever. To figure out how long it takes your money to double, just divide 72 by your annual return rate. So if you're earning 8% a year, your money doubles every 9 years. At 12%, it doubles every 6 years. That might not blow your mind yet. But watch what happens. Every time it doubles, it's not just doubling your original investment. It's doubling the new, bigger amount. It becomes 2, then 4, then 8, then 16, then 32 times what you started with. Start with a single penny and double it every day for 30 days? You'd have over $5 million. That's compound interest at work, and the absolute most important ingredient is time. The authors illustrate this with a story that'll stick with you. Imagine 2 people. Eric Early starts investing at 25. He puts $4,000 a year into his retirement account for just 10 years, then stops completely. Total investment, $40,000. His friend Larry lately doesn't start until 35, but he's more diligent. He invests $4,000 every single year for 30 years straight until retirement. His total investment, $120,000, 3 times what Eric put in. Who ends up with more money at 65? Even though Eric invested for only 10 years and stopped, his money had an extra decade to grow and compound. At 65, assuming 8% returns, Eric's $40,000 turns into nearly $630,000. Larry, who invested 3 times as much, ends up with only about $489,000. Eric started 10 years earlier and finished with nearly 30% more money, despite investing a third of the amount. If you're young, you're literally standing on a mountain of gold. That gold is time. The biggest investment mistake isn't picking the wrong stock. It's not starting at all. The book hammers this home. Deciding how much to save is the most important financial decision you'll ever make, because you can't invest what you don't save. Now that we understand the why, the power of starting early, let's talk about the what. What exactly are we buying? The book breaks down the two main building blocks, stocks and bonds. Imagine a successful pizza company. When you buy a stock, you're buying a tiny slice of that company. You're literally a part owner. If the company crushes it, makes huge profits and grows, your slice becomes more valuable. You make money. If the company struggles, your slice can lose value. Higher risk, higher reward. Now imagine that same pizza company wants to expand and build a new factory, but doesn't want to sell more ownership. Instead, it borrows money. When you buy a bond, you're essentially lending your money to that company or a government. In return, they promise to pay you back on a specific future date, the maturity date, and they pay you regular interest along the way. Generally lower risk, lower reward compared to stocks. Bonds are for stability. The authors explain there are many types of bonds, but for most of us, the safest are U.S. government treasury bonds, backed by the full faith and credit of the United States. Here's something crucial. There's a silent thief constantly trying to steal your money's value. That thief is inflation. Inflation means $1 tomorrow buys less than $1 today. Just 3% inflation means in 24 years, your money loses half its purchasing power. To fight this, the U.S. Treasury created special bonds called TIPS, Treasury Inflation Protected Securities, and I-bonds. These bonds automatically adjust upward with inflation, guaranteeing your investment keeps its buying power. They're among the safest investments on the planet for preserving wealth. You can buy individual stocks and bonds, but for average folks, this is tricky and risky. Put all your money in one company's stock, and that company goes bankrupt. Think Enron. You could lose everything. To stay safe, you need to diversify, spreading your money across many companies and industries. But buying dozens of individual stocks gets expensive and complicated fast. This is where the Bogleheads' most important tool enters, the mutual fund. A mutual fund is simply a big pool where thousands of investors combine their money. A professional manager takes that giant pool and buys hundreds or even thousands of different stocks or bonds. When you buy one share of a mutual fund, you instantly own a tiny piece of all those investments. Instant diversification. There are two main management styles. Active management is where a manager and their team spend all day trying to be brilliant, picking winning stocks and avoiding losers, timing the market to buy low and sell high. They're trying to beat the market. For this service, they charge higher fees. Then there's passive management, also called indexing. An index fund manager doesn't try to be a hero. They have one simple job: replicate the performance of a specific market index, like the S&P 500, a collection of 500 of the largest U.S. companies. If a company's in the index, they buy it. If not, they don't. No stock picking, no market timing, no trying to outsmart anyone. The goal isn't beating the market. It's being the market. Because this is so much simpler and can be done largely by computers, index fund fees are incredibly low. This brings us to the absolute heart of the Boglehead philosophy, and it's a truth so powerful and counterintuitive that Wall Street spends billions of dollars annually trying to convince you it's not true. Here it is. Over long periods, the vast majority of actively managed funds, run by the so-called experts, fail to beat simple, low-cost index funds. Studies show as many as 80 to 90% of active funds underperform their index benchmark over 20 years. How is this possible? Why do average index funds consistently beat the experts? One word: costs. The authors call this the relentless rules of humble arithmetic. Imagine two investors in the same market earning 10% for the year. The active investor pays a 2% fee to their fund manager. The index investor pays 0.1%. At year's end, the active investor earned 8%, while the index investor earned 9.9%. That small difference, compounded year after year, becomes a Grand Canyon-sized wealth gap over a lifetime. High fees, sales commissions, and hidden trading costs of active funds create a constant headwind, while low-cost index funds give you a steady tailwind. As John Bogle himself said, the shortest route to top quartile performance is to be in the bottom quartile of expenses. In investing, you don't get what you pay for. You get what you don't pay for. So the Boglehead strategy is making low-cost index funds the core, or even all, of your portfolio. It's a strategy requiring almost no time, no special skill, yet it outperforms about 80% of professional investors. But which funds? And how much in stocks versus bonds? This leads to what the book calls the single most fundamental decision: asset allocation. Asset allocation is simply deciding how to divide your investments among different asset classes, primarily stocks, bonds, and cash. Why does this matter so much? Because stocks and bonds don't always move together. When stocks soar, bonds might plod along. But when stocks crash, high-quality bonds often hold steady or even rise, acting as a crucial shock absorber. A famous study found over 90% of a portfolio's return variability comes from asset allocation, not from picking the right stocks or timing the market. How do you decide your allocation? The book offers a simple starting point from John Bogle himself. Own your age in bonds. 20 years old? Maybe 20% bonds, 80% stocks. 60 years old? 60% bonds, 40% stocks. As you age, you gradually shift from growth-focused stocks to preservation-focused bonds. This isn't a rigid rule, just a guide. The more risk you can handle, the more you lean towards stocks. The less you can stomach watching your portfolio drop, the more you lean toward bonds. The book includes a questionnaire to help determine your risk tolerance. The goal is creating a portfolio that lets you sleep at night, even during scary market crashes. This is the sleep test. A simple, powerful Boglehead portfolio for a young person might look like this: 80% in a total stock market index fund, one fund holding thousands of U.S. stocks, giving you ownership in nearly the entire U.S. economy. 20% in a total bond market index fund, one fund holding thousands of high-quality U.S. bonds, providing stability. Many Bogleheads also add a total international stock index fund to capture global growth, suggesting about 20% of your stock portion go international. That's it, a three-fund portfolio: simple, diversified, low-cost, powerful. Once you have your plan, the work is mostly done. But there are a few final, crucial principles for managing your investments long-term. First, tune out the noise. The financial media, TV shows, magazines, websites aren't in the business of making you a better investor. They're in the business of attracting audiences to sell advertising. They do this by creating excitement, fear, and urgency. They parade experts, confidently predicting where the market's headed, even though study after study proves nobody can consistently predict short-term market movements. They tout hot funds of the moment, encouraging you to chase past performance. But Bogleheads know performance chasing is a loser's game. Last year's number one fund is very unlikely to be number one next year. Often last year's winners become next year's losers. As the saying goes, past performance is no guarantee of future results. The authors are blunt. Believe it. Second principle: master your emotions. The market's two great drivers are greed and fear. When the market soars, greed takes over. People get overconfident, pile into risky investments, follow the herd, buying high. When the market crashes, fear takes over. People panic and sell everything, locking in losses. The average investor consistently underperforms the market precisely because emotions drive their decisions. The successful investor has a plan and sticks to it, regardless of noise and emotional roller coasters. This leads to the final, most important Boglehead mantra: stay the course. Once you have your simple, low-cost, diversified plan, the most important thing you can do is nothing. let your automatic investments work. Rebalance, perhaps once a year. Sell a bit of what's done well. Buy a bit of what's done poorly to restore your original allocation. Otherwise, ignore the headlines. Ignore the gurus. Ignore the urge to do something. As John Bogle said 1,000 times, stay the course. It is the most important single piece of investment wisdom I can give you. Because building wealth isn't about excitement, it's about discipline. Not about being a genius. About being patient. About understanding a few simple, powerful truths, and having the courage to stick with them for a lifetime. Allowing the magic of compounding to do its quiet, wonderful work. When you really boil it down, the Bogleheads' Guide to Investing feels almost revolutionary in today's world of complex financial products and non-stop market noise. The core idea is radically simple and profoundly humble. The book's most powerful lesson? In investing, your greatest enemy is often yourself. It's your emotions, greed when the market's hot, fear when it's crashing. It's your overconfidence, believing you or someone you hire can outsmart millions of investors worldwide. And it's your impatience, wanting quick results in a game that rewards the long view. The Boglehead philosophy is an antidote to all that. It's a system designed to protect you from your own worst instincts. By automating savings, investing in the whole market through index funds, and committing to stay the course, you're taking your ego and emotions out of the driver's seat. You're admitting you don't know where the market's going tomorrow, and that's perfectly okay, because you don't need to. Your success isn't dependent on prediction. It's dependent on participation. What I find so empowering, especially for someone just starting out, is how this completely democratizes wealth building. You don't need a fancy degree, you don't need to be born into money, and you certainly don't need to pay a high-priced advisor to hold your hand. The tools for success are available to everyone, surprisingly simple and inexpensive. It's a philosophy of empowerment. It's about taking control of your financial destiny, not by trying to be a market genius, but by being a disciplined, intelligent consumer of financial products. It teaches you to focus relentlessly on the few things you can actually control: how much you save, the costs you pay, the taxes you incur, and your own behavior. Get those 4 things right, and the market handles the rest. If you were to take just a few actions after hearing this today, what should they be? First, embrace paying yourself first. Right now, go to your bank's website and set up an automatic transfer from checking to savings for the day after you get paid. Doesn't have to be huge. Start with $25 or $50. The goal is building the habit. Make saving automatic so it happens without thinking. Second, open a Roth IRA. This retirement account lets your money grow completely tax-free. At a young age, this is one of the most powerful wealth-building tools you'll ever have. Inside that Roth IRA, start with a single, low-cost target date fund or total stock market index fund. Third, once that's set up, make yourself a promise. Promise you'll ignore the noise. You won't check it daily. You won't sell when the market crashes. You'll simply let it be and continue feeding it, month after month, year after year. That's it. That's the start. You'll be laying the foundation for financial freedom, not with complexity and stress, but with simplicity and peace of mind. That was a summary of the Bogleheads' Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf. We've journeyed through the core principles today, but honestly, a summary is like looking at a photograph of the Grand Canyon. It can show you the landscape, but it can never capture the feeling of standing on the edge, seeing the scale and beauty for yourself. The real magic happens when you read the book. It's in those quiet moments when a particular story or simple phrase connects with you unexpectedly. This summary helps you decide if this book's worth your time. If anything we've talked about today resonated, I truly encourage you to grab a copy. Reading it isn't just learning. It's an experience that can genuinely change how you see your financial life. The link's in the description. Also, if you found this summary valuable, if it sparked a new idea or gave you some clarity, do me a small favor and hit that subscribe button. That way, You won't miss our next journey into another life-changing book. Let's keep learning and growing together.